Welcome to Annual International Accounting Virtual Conference. Financial Statements for Personal Accounting and Business Accounting.
Good morning, everyone. Welcome to the annual International Accounting Virtual Conference. Thanks for joining us today, November 17, 2022. It is a pleasure to me to introduce the rest of the accounting team of Financial Expert Consultancy. The topic that we will develop in this conference will be divided in two parts. Number one, we will start with an overview about the financial statement for personal accounting, but also for business accounting. This is the agenda for today. For personal accounting and income statement will be presented by Annie Paola. Then we will move to balance sheet, personal balance sheet, presented by Sofia. Then we will start talking about business accounting, business financial statement, in charge of Albert. Following the same topic, business income statement for Utpala, business balance sheet presented by Vishali, owner's equity statement in charge of Pratima, and finally, cash flow statement presented by Jericho. Okay, let's start with a brief summary about the history of the accounting and how have been its evolution through the story.
The history of accounting has been around almost as long as money itself. Accounting history dates back to ancient civilizations in Mesopotamia, Egypt, and Babylon. For example, during the Roman Empire, the government had detailed records of its finances. However, modern accounting as a profession has only been around since the early 19th century. Luca Pacioli is considered the father of accounting and bookkeeping due to his contributions to the development of accounting as a profession.
What is accounting? It is important to understand the meaning of accounting. We can define accounting by saying that it is a process of keeping financial reports. Another definition is a systematic recording and reporting, analyzing of financial activities that is equal to transactions for personal, business, or organization. For businesses, accounting allows company to analyze their financial statement in certain periods of time. Okay, now, after defining the general concept of accounting, what is personal accounting? It's similar, but it's applied for individual. It's the same, recording of financial activities, but just for person. How a person record, measure, classify, verify, and identify increases or decreases in his or her net worth. In the following slide, we will define what is net worth. Now, what are the benefits of personal accounting? Number one, personal accounting allows people to manage their finances effectively. Number two, people can gain a better understanding about how the way they manage their finances can affect their financial condition. Number 3, people can be prepared for entrepreneurial success. And last one, you can improve your decision making capabilities in financial terms. The personal financial statement, it's divided, or we can classify it in 2 types. Number 1, personal income statement, and number 2, the personal balance sheet. What is the personal income statement? We can define it saying that it's a record that people can use to show and summarize incomes and expenses, to determine what are the changes in net worth over a specific period of time. The benefits of using a personal income statement. This tool can help you to make better decisions about how to generate more profits by increasing revenues or reducing your costs, or both at the same time. Number 2, you can understand how well are you managing your finances. It can help people to forecast movement that will be generated in the upcoming months. And the last one, makes tax filing easy for people. In the previous slide, we mentioned incomes and revenues. Those are 2 key elements in the personal income statement. But what are incomes? Incomes are represented, for example, by your salary, earnings that you obtain for an investment, or earnings for saving. And expenses are represented by bills that are you responsible to pay every month. For example, food expense, insurance, maintenance, rent, utilities. Those that represent out of money are your expenses. Now, let's analyze the next personal income statement. This is an example. Andres Gonzalez presented his personal income statement for the year ended December 31, 2021. He started with a revenue of $46,000, but during that period of time, he had expenses of food, insurance, maintenance, rent, and utilities. Those by a total of $31,900. So the income that Andres obtained after subtract his revenue with the total of their expenses is $14,100. If the result would be negative, Andres would have a deficit, but in this case, it is positive. So it's a surplus. That means that these incomes represented in a surplus will be added to his net worth, that will be represent an increase in the net worth balance sheet. For the next part of this presentation, we will continue speaking about the personal balance sheet. Now it's your turn, Sofia. Thank you so much.
Good day. Thanks for continuing here in our annual International Accounting Virtual Conference. And let's continue with our next topic, which is very interesting. Is the personal balance sheet. And I would like to introduce you to this topic with a brief summary about the importance of have a personal balance sheet in our life and you as individuals. And a personal balance sheet can illustrate if you are on the right path to accomplish your goals, such as getting out of debt, or showing you how much and what you own, what debts you have to repay, and how much you are in worth in total. Create a personal balance sheet referred to as a statement of financial position by planners of all the assets and liabilities. This will give to the person a better idea of the total financial picture, more than a budget or expenses spreadsheet, because it lists out all of the big picture things that the person owns or of, not just what he's spending money on day to day. Personal balance sheet is a document that describes the personal financial position of an individual at a given time, detailing the liabilities and the assets. The personal balance sheet reveals what a person owes as a asset, and that is the assets, and also show what person owed, that it is the total liabilities, at a specific point in time to gain an understanding of current events of his financial conditions. A balance sheet also provides the financial information that a person needs to sustain and grow his economy over the time, and provides helpful ratios as liquidity, solvency, profitability. It is a snapshot that reveals person's overall capital capacity. Having described this, please take a note. We are going to do a little exercise of how to build personal balance sheet. This might take longer to accomplish than some of other tasks, but it's worth the effort. First step is gather the financial documents. For example, if a person has been tracking his spendings, then he has an idea of where his money is going. Otherwise, he'll need to collect his monthly loan and credit card statements, as well as bank and investments accounting balances, in order to list out all his assets and liabilities. The assets are things that a person owns that can have value, including any cash savings, the value of home, cars, certificate of deposits, retirement, and other investments accounts, real estate, jewelry, and inclusive heirlooms. Liabilities are money you or the person owe to another person or a financial institution, included credit card debt, student loan debt, car loans, mortgages, personal loans, and medical debt, and others. After list out this, we are going to build our second step, that is list assets and liabilities. So once a person has all of the documents, use an Excel sheet or a paper, a pen, or just search for a template in online to list out your assets and liabilities, all the things that I already told you. You have to list in 2 columns. Side by side, include the value of each item, so you can add up the totals at the end. All of the values should be from the same day, so that this sheet reflects the same. a single point in time of finances. In our last step, the third step is assess the balance sheet. And once a person have everything listed out, add up each column and subtract the total liabilities from the total assets. So you will have your net worth. After that, a person have to take a closer look at each column and analyze what are his assets and liabilities. Finally, schedule a reminder to update the balance sheet regularly, such as once a year or in a quarter. And that way we'll always have the up-to-date information a person needs to see if he's in the track or on the track to accomplish his financial goals, and knows all about his real net worth. In this slide of personal balance sheet is the structure as I explained it to you, and how to build, and a little exercise of how to build the personal balance sheet. You can see now how is the structure of the personal balance sheet. So there is an assets, that is what you own, the liabilities, that is what you owe, and finally net worth, and that is the amount you own minus amount you owe. And we would like to give you a personal balance sheet example. As you can see, this is the Andres Gonzalez personal balance sheet for the year ended 31 in 2021. Here is described his assets, liabilities, and net worth at that time. As you can see, the assets contain cash for $8,000, contents of home for $6,000, car $11,000, and house for $121,000, for total assets of $146,000. The liabilities were unpaid accounts, $600, mortgage for $100,000, bank loan for $6,000, and total liability of $106,600. Then next is the net worth, that is the subtraction from the total assets and total liabilities. And here we have a net worth of $39,400. And the total liability net worth is again the total assets, $146,000. It is important that you know that the assets not always represent the cash. As you can see here, it represents all that the person have, like content of home, car, and houses. And that the movement of money between assets and liability doesn't affect the net worth. Just if a person paid interest for a bank can affect these accounts, but on the other hand, the net worth will be not affected. Okay, so let's continue with the next topic.
Hello everyone, I am Elber Soares. In this part, I am going to talk about business accounting. Business accounting is the process of recording financial transactions pertaining to a business. The accounting process includes summarizing, analyzing, and reporting these transactions to oversight agencies, regulators, and tax collection entities. The purpose of business accounting. Accounting is one of the key functions of almost any business. It may be handled by a bookkeeper or an accountant at a small firm, or by sizable finance departments with dozens of employees at larger companies. Benefits of doing business accounting: proper maintenance of the business records, convenient preparation of financial statements, helps in making business decisions, helps in handling taxation, makes financial information available to stakeholders, helps determine the value of the business. The 8 types of accounting. Financial accounting refers to the process used to generate interim and annual financial statements. The results of all financial transactions that occur during an accounting period are summarized in the balance sheet, income statement, and cash flow statement. Management accounting is a method of accounting that creates statements, reports, and documents that help management in making better decisions related to their business performance. Management accounting is primarily used for internal purposes. Governmental accounting, the managing and budgeting of public revenue. It accounts for activities, programs, and other liabilities. The government is accountable to its citizens and taxpayers. Public accounting is an organization that offers accounting expertise and service to corporations, governments, non-profit organizations, or individuals. Cost accounting. This is a form of managerial accounting that aims to capture a company's total cost of production by assessing its variable and fixed costs. Tax accounting. While financial accountants often use one set of rules to report the financial position of a company, tax accountants often use a different set of rules. These rules are set at the federal, state, or local level based on what return is being filed. Forensic accounting utilizes accounting, auditing, and investigative skills to examine the finances of an individual or business. Audit accounting can be an internal process with a focus on mitigating risk and identifying areas where cost savings can be made. Thank you for your attention.
Business financial accounting should be prepared according to the following steps: income statement, statement of owner's equity, balance sheet, statement of cash flow.
Hi, this is Utpala and I'm going to talk about business income statement. Business income statement, or in other words, we could say P&L or profit and loss account, is prepared for a specific period of time in order to assess the financial health in an organization. So this income statement mainly consists with revenue and expenses for a specific period of time. So when it comes to organization, they can prepare their income statement in different time frameworks such as monthly, quarterly, or annually. Normally, most of the time we can see annual income statement, and also depending on the requirement, organization can separate their income statements based on the different department and sectors within the organization. When it comes to the components of business income statement, it consists with sales revenue, cost of sale, gross profit, overhead cost or expenses, other expenses, net loss or net profit. As I mentioned earlier, the main objective or purpose of preparing this income statement is to assess the profitability of the organization for a specific period of time. So there are different parties who are keen on the financial health or financial performance in an organization. It could be top management or any other external stakeholders. For an example, when it comes to lenders or investors, they are more focused on the liquidity, solvency, or operational efficiency in an organization, because depending on the nature of those information, they could take their lending and investment decision. So in that case, in income statement gives more in-depth details in order to meet their information requirements. Also, income statement could be used for the future projections, because income statement consists with historical data, and based on this historical data we can project or forecast what sort of financial health can be projected in future period. Thank you very much.
Hi, my name is Pratima Kesi, and I'm presenting about statements of owner's equity. A statement of owner's equity is a financial statement that presents a summary of the changes in the shareholders' equity accounts over a given period. In other words, it reports the events that increased or decreased stockholders' equity over the course of the accounting period. This statement of owner's equity is one of the shorter financial statement, because there are not many transactions that actually affect the equity accounts. It typically contains the net income or loss for the period, along with the owner's contribution or withdrawals during the period. Um, the statement of owner's equity helps users of financial statements to identify the factors that cause changes in the owner's equity over the accounting period, such as net profit and loss, increase or decrease in share capital reserve, shareholders' dividend payment, and changes in accounting policy. The statement of owner's equity is simply calculated as beginning equity balance plus net income and investment, which is also called owner's contribution, less net loss and owner's withdrawals. After that, we'll get ending equity balance or ending capital. The ending equity account balance is always carried forward to the following year and become future years beginning balance. And obviously, the first year a business started, it will not have a beginning balance. It will always be zero. Let's take a look at the example. We have a statement of owner's equity of finance export consultancy. The balance of capital balance January 1 2022, we have zero. Investment 35,000, net income 11,750, less withdrawal 3,000, and after the calculation we have capital of $43,750. Thank you.
Hi, this is Vishali, and my topic is balance sheet. A balance sheet is a financial statement that gives a reader a snapshot of the company's financial condition at a point in the time, and it lists out what the company owns and what the company owes, give insights into the overall health of the business. And next, we will talk about what are the benefits of the balance sheet. And there are the 4 points which we will talk about the 4 benefits. And firstly, it helps in the business owners and managers make better strategies, and it also helps in the risk and returns. Other than that, it helps in bankers and investors make sound investing decisions. Apart from that, it helps provide helpful ratio. So these are the benefits of the using balance sheets. Next, what are balance sheet? These are the assets, liabilities, and owners equity. In assets, it's come cash, accounts receivable, prepaid insurance, and furnitures and fixtures. And in liabilities, we will talk about accounts payables, unreturned revenue, bank loan, and owner's equity, we will talk capital. And next, there is a balance sheet example of the month June 2022, in which cash 35,000, account receivable 4,000, $4,000, and prepaid insurance is $45, furniture is $9, and overall total assets is $52,500, and liabilities is $2,000. Unreturned revenue is $2,250. Bank loan is $45,000. Total liabilities will be $8,750. And total, and after that we will talk about owner's equity, how to come in which we will have capital, that is $43,750, and total liabilities will be plus owner's equity is equal to $52,500. And this is the balance sheet. Thanks. Bye bye.
Hello, my name is Jericho, and I'm here to talk about cash flow statement. A cash flow statement is a financial statement that provides aggregate data regarding all cash inflows a company receives from its ongoing operations and external investment sources. It also includes cash outflows that pay for business activities and investment during a given period. The cash flow statement, or CFS, is a financial statement that summarizes the movement of cash and cash equivalent that come in and go out of the company. The purpose of cash flow statement is to provide a detailed picture of what happened to a business cash during a specified period known as accounting period. It demonstrates an organization's ability to operate in a short and long term, based on how much cash is flowing into and out of the business. The purpose of statement of cash flows is to present cash inflows and outflows for a reporting period to the reader of the report. These inflows and outflows are further classified into operating, investing, and financing activities. The information is used by the investing community to discern the ability of an organization to generate cash and how the funds are then used. There are two types of calculating cash flow statement. One is direct method and the other one is indirect method. In this presentation, we will talk about the indirect method. There are three sections. One is the operating activities, investing activities, and financing activities. Operating activities include cash activities related to net income. Investing activities include cash activities related to non-current assets. Financing activities include cash activities related to non-current liabilities and owner's equity. As stated below, the statement of cash flows of Finance Expert Consultancy for the month ended June 30, 2022.
On behalf of Finance Expert Consultancy, thank you for your attention and see you soon.